As of Wednesday, May 13th, 2026 at 1:26 p.m. Eastern Time, Plug Power stock is currently trading at $3.56 per share, representing a steady intraday movement of 1.14% as the market processes a significant shift in the fundamental narrative of the hydrogen sector. While a few cents of movement might look like a quiet day for a high beta ticker, the reality under the surface is that Plug Power just delivered a massive shock to the system with its first quarter results. Most investors went into this week expecting another round of missed targets and dilution talk, but the data that just hit the tape reveals a company that is finally starting to close the gap between its ambitious vision and its actual bank account. The expectation was that Plug Power would continue to burn through cash at an unsustainable rate while struggling to scale its green hydrogen production. The reality is that revenue just jumped 22% year over year to $163.5 million, absolutely crushing the consensus estimate of $140 million. This isn't just about selling more fuel cells. It is about a 71% improvement in gross margins. If you've been following this stock for more than a week, you know that margins have been the Achilles heel for years. Seeing them swing from negative 55% to negative 13% suggests that the internal initiative known as Project Quantum Leap is actually working. This creates a curiosity loop for anyone looking at the broader energy transition. If Plug can actually hit positive EBITDA by the fourth quarter of 2026, as they've now reaffirmed, we aren't looking at a speculative penny stock anymore. We're looking at the legitimate anchor of the domestic hydrogen economy. Despite this progress, the common ground among retail investors on social media and message boards remains heavy skepticism. The prevailing belief is that Plug Power is a dilution machine that only exists to sell shares to unsuspecting investors. It's easy to see why people think that, given the historical price action, but if you look at the recent institutional activity, a different picture starts to emerge. Large-scale players like Vanguard and Mitsubishi UFJ Asset Management have been significantly increasing their stakes. This suggests that the smart money is beginning to value the infrastructure more than the immediate quarterly profit. They aren't just looking at the ticker, they're looking at the 100-megawatt system recently completed at Galp's refinery in Portugal, and the massive project pipeline that now exceeds $8 billion. While most traders are busy looking at 15-minute candles on a Robinhood app, the institutions are positioning themselves for a scenario where hydrogen becomes the primary backup for the AI-driven power crunch. The recent movement has been driven by a perfect storm of earnings outperformance and sector-wide momentum. When Bloom Energy recently raised its full-year guidance, it sent a signal that the demand for off-grid power is surging. Plug Power is riding that same wave. Volume has been through the roof this week, with nearly 200 million shares changing hands in a single session. That kind of liquidity doesn't happen by accident. It's a sign of a massive tug-of-war between short sellers who are being forced to cover and new bulls who are using an individual brokerage or various investing sites to build long-term positions. The technicals are starting to reflect this shift too. The stock is holding firmly above its 50-day and 200-day moving averages, which is something we haven't seen with this much conviction in a long time. If you are using tools like Schwab Intelligent Portfolios or looking for investment help through automated platforms, you might notice that clean energy is starting to get a higher weighting again. The macroeconomic pressure of high interest rates was a death sentence for capital-intensive companies like Plug in 2024 and 2025. But as we move through 2026, the market is starting to price in a more stable environment. More importantly, Plug is finding ways to fund itself without just printing new shares. They have a $142 million deal with Stream Data Centers expected to close in June, and another $275 million coming from project asset monetization. This is a massive shift in how they manage their balance sheet. Instead of begging Wall Street for cash, they are selling the value of the infrastructure they've already built. Let's look at the actual business model for a second, because it's often misunderstood. Plug Power isn't just a manufacturer. They have built an integrated ecosystem that covers everything from the production of green hydrogen to the storage, transport, and final consumption in fuel cells. Their material handling business is already a staple for giants like Walmart and Amazon. These companies aren't using hydrogen because it's green. They're using it because it's more efficient than lead-acid batteries for high-intensity warehouse operations. The real growth, however, is coming from the electrolyzer side of the house. Revenue in that segment skyrocketed over 340% recently. This is where the world is heading. As industries like steel and shipping try to decarbonize, they need electrolyzers to create fuel, and Plug is one of the only companies on the planet capable of delivering at scale. For those of you managing your own portfolios through Fidelity or Interactive Brokers, the question is always about the risk-reward profile. The risk with Plug has always been the going concern warning and the fear of bankruptcy. But with over $800 million in total cash and restricted cash on hand, plus the incoming hundreds of millions from asset sales, the immediate threat of insolvency has drastically faded. This is why the short interest is starting to look like a liability for the bears. If Plug continues to deliver these 20% plus revenue growth numbers while narrowing losses, the reality is going to keep surpassing the expectation of failure, which is the classic setup for a long-term squeeze. In the world of online investing, it's easy to get distracted by the next shiny object, but the energy transition is a multi-decade shift. Plug Power's strategy of building its own hydrogen plants, like the one in St. Gabriel, Louisiana, is a massive bet on the price of hydrogen itself. Right now, sourcing fuel is expensive, which drags down their margins. But as their own plants come online and they stop buying from third parties, those fuel margins are expected to flip from a massive loss to a significant profit. We're already seeing the beginning of that, with fuel margin rates improving by 54 percentage points in the last year. That is a staggering move in a very short period. Now, I want to hear from you. Comment below how many shares of Plug Power you currently hold, or if you're waiting for a specific price target before you jump in. The sentiment on this stock is always polarized, and I'm curious to see where this community stands after these latest earnings. Looking ahead, the catalysts are clear. We have the $142 million June closing, the continued rollout of the PJM grid auction offerings, and the steady march toward that Q4 2026 profitability target. If the government continues to support the hydrogen production tax credits, the tailwinds could get even stronger. However, the risk remains in execution. Building hydrogen plants is hard, and any delays in the Louisiana or Georgia facilities will be punished by the market immediately. The expectation is that the path to profitability is now a straight line. The reality is that industrial scaling is always messy. As we wrap up this analysis, it's clear that Plug Power is no longer the same company it was 2 years ago. The shift from a pure-play fuel cell manufacturer to a vertically integrated energy company is nearly complete. The contrast between the expected failure of their business model and the reality of their 22% revenue growth is why the stock is finally seeing some sustained interest. Whether you are using the Fidelity mobile app to trade the daily swings or you're a long-term holder using SoFi Invest to build a position in the future of energy, the data suggests that the worst might finally be in the rearview mirror. The authoritative take here is that Plug Power has successfully pivoted from surviving to optimizing. They are no longer just burning cash to stay alive. They are spending it to build a moat in an industry that is critical for the next phase of the global energy grid. The tension between the skeptical market narrative and the improving financial metrics is exactly where the opportunity lies. If you believe in the hydrogen economy, Plug is the most direct way to play it, provided you have the stomach for the volatility that comes with being a pioneer. Expect more volume, expect more headlines, but most importantly, expect the reality of their operational improvements to continue challenging the expectations of those who bet against them. Maintain your focus on the cash flow and the margin expansion. Those are the only two numbers that truly matter as we head into the second half of 2026. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, outshare with your friends. Bell subscribe for more updates.